Right now, something unusual is happening in the silver market, not gradually, not quietly, but aggressively, and in a way that doesn't fully align with how markets are supposed to behave. Silver has just surged past $77 per ounce, gaining more than 5 to 7% in a single session, after trading near $72 just days ago. And here's the part that should make you stop for a second. This move is happening while global tensions are technically cooling down, not escalating. April 8th, 2026. A temporary ceasefire between the United States and Iran has just been announced, with the Strait of Hormuz reopening, a route that carries nearly 20% of the world's oil supply. Oil didn't rise, it dropped sharply, by nearly 15% in a single move, one of the largest declines since the COVID-era volatility. Stocks didn't panic, they rallied globally, from Europe to Asia in what analysts are calling a relief-driven liquidity response. The US dollar, instead of strengthening, it weakened. And silver, it didn't wait, it accelerated. Pause. Because historically, that combination doesn't usually produce a breakout in silver. It may produce stability, it may produce consolidation, but not this kind of move. And that's exactly why you need to pay attention right now. Because when markets behave outside their historical patterns, it usually means something deeper is shifting underneath. Let's slow this down, because what you're seeing right now is not just a reaction, it may be a signal. Across global financial systems, institutions like the International Monetary Fund and central banks continuously monitor three core forces: inflation, liquidity, and volatility. And right now, all three are moving at the same time. The ceasefire has temporarily reduced geopolitical risk, which in theory should reduce inflation pressure coming from energy markets, because when oil drops, input costs across the global economy may ease. And that matters because central banks, including the Federal Reserve, have been aggressively managing interest rates to control inflation over the past cycle. But here's where things start to get complex, because while oil prices dropped and inflation expectations may ease in the short term, liquidity conditions are shifting in the opposite direction. Bond yields have softened, the dollar has weakened, and markets are starting to price in the possibility that central banks may not need to stay as restrictive as before. That matters, because silver is extremely sensitive to real interest rates, not just nominal rates, but real yields, which account for inflation. And historically, when real yields decline, precious metals tend to strengthen, not always immediately, but consistently over time. So what you may be seeing right now is not just a reaction to a ceasefire, but a reaction to shifting expectations about monetary policy itself. And that's where the story changes, because now silver is no longer just reacting to headlines. It's reacting to macro conditions. And here's something most people are not fully paying attention to. Silver is not just a safe haven asset, it is also an industrial metal, which means it responds to two completely different forces: fear and growth. Right now, both are present. On one side, you still have geopolitical uncertainty, because while a ceasefire has been announced, even analysts and policymakers acknowledge that its durability remains uncertain. On the other side, you have expectations of continued demand from sectors like solar energy, electronics, and industrial manufacturing. So silver sits in a unique position between protection and expansion, and that dual nature is what makes moves like this more complex. Now pay attention, because this is where things start to get even more interesting. Despite this rally, silver is still considered relatively underowned compared to other major asset classes, meaning large institutional allocations remain limited. And historically, when an asset is underowned but begins to show momentum, it doesn't move slowly, it accelerates. Because positioning matters. Think about how capital flows work. Large institutions, including hedge funds, pension funds, and sovereign entities, don't move instantly. They adjust gradually. They build positions over time, and often the first phase of a move happens before full participation arrives, which raises a very important question. Is this move just a reaction or the early stage of something larger? Because if you look closely, the data suggests this may not be a random spike. Silver has now broken back above the $76, $77 range, which many analysts were watching as a key resistance zone. And price action is showing increasing strength, not weakness. At the same time, momentum indicators are strengthening, but not yet at extreme levels, which means the move may not be fully exhausted. Now stop for a second and really think about that. because this is where most people make a mistake. They assume that once a move has already started, they've missed it. But in many cases, the initial move is just the beginning of a larger trend. And that's where timing becomes critical, yeah? Because markets don't move in straight lines. They move in phases. And right now, silver may be entering a transition phase, a phase where macro conditions are shifting, liquidity is adjusting, and institutional positioning may be starting to build. And those phases can become very volatile. Not always upward, not always smooth, but significant. Now here's something else you need to understand. Silver's behavior today is also tied to the dollar, because silver is priced globally in US dollars. So when the dollar weakens, silver becomes relatively cheaper for global buyers. And that increases demand. Right now, the dollar has softened following the ceasefire announcement as investors unwind defensive positioning, which has created a tailwind for metals. But again, this is not guaranteed to continue because currency markets are highly sensitive to central bank decisions, economic data, and geopolitical developments, which means this move could evolve. But the key point is this. Silver is not moving randomly. It is reacting to a combination of geopolitical shifts, monetary expectations, and liquidity changes. And when multiple forces align, markets tend to move more aggressively. Now, here's the part most people are still not fully seeing. Even though oil prices drop sharply, physical supply chains remain under stress. And analysts continue to warn that deeper structural issues have not been fully resolved, which means volatility may not be over. And in environments of uncertainty, assets like silver often play a more complex role, not just as protection, but as a reflection of how capital is repositioning globally. So what you're watching right now is not just a price spike, it may be a signal that something in the system is beginning to shift. And most people haven't fully recognized it yet. Now here's where things start to get uncomfortable, because what you're watching right now is not just a reaction to a ceasefire. It may be the market quietly repositioning before something bigger becomes obvious. Step back for a moment. Just 48 hours ago, markets were pricing an escalation. Oil was surging, inflation fears were rising, and central banks, especially the Federal Reserve, were expected to remain tight, possibly even extend restrictive policy. That's how fast things flipped. Because when oil was trading above $110 per barrel, the assumption was simple. Higher energy prices mean higher inflation, and higher inflation means central banks cannot cut rates. That's basic macro. That's how the system has behaved historically. But then suddenly, the ceasefire hits, oil collapses, and yields begin to fall. Bond markets reacted immediately because bond traders don't wait. They anticipate. U.S. Treasury yields dropped as markets began to price in a shift. Not confirmed, not guaranteed, but possible. And that word matters, possible. Because in financial markets, prices don't move on certainty, they move on expectations. And right now, expectations are shifting. According to recent market positioning, the probability of interest rate cuts later this year has started to increase again, not dramatically, but noticeably. And that creates a chain reaction. Lower expected rates mean lower real yields. Lower real yields historically support non-yielding assets, assets like silver. Now pay attention, because this is where things get even more layered. At the same time this is happening, the International Monetary Fund has already warned about a global environment of slower growth and persistent inflation pressures, what economists call stagflation risk. And that's a dangerous combination, because in a stagflation environment, traditional assets struggle, growth slows, but prices remain elevated. And that forces capital to look for alternative stores of value. Historically, that's where metals enter the picture, not as a guarantee, but as a possibility. And right now, silver sits right in the middle of that conversation. Now, here's something most people are still not connecting. This rally is happening after silver had already been under pressure. Just days ago, silver was trading near $72, $73 levels, and even showing signs of weakness during peak conflict. Think about that. During rising geopolitical tension, silver didn't explode higher. But now, as tensions ease, it surges. That inversion is what makes this situation different, because it suggests that silver may not just be reacting to fear, it may be reacting to liquidity. And liquidity is the most important force in markets, always. When liquidity expands, assets rise. When liquidity contracts, assets fall. And right now, liquidity conditions may be starting to loosen again, not fully, not officially, but subtly, because central banks don't always act first. Markets often move before they do. Now here's your first curiosity hook. What if this move in silver is not about the ceasefire at all? What if the ceasefire is just the trigger, but not the cause? Because if that's true, then the real driver is something much deeper. And that's where institutional behavior comes in. Large financial institutions don't react to headlines the way retail traders do. They focus on flows, positioning, macro shifts. And right now, there are early signs that positioning may be changing, not dramatically, but enough to matter. Silver futures positioning data suggests that the market is not overcrowded, meaning this rally is not driven by extreme speculation. That's important because overcrowded trades tend to reverse quickly, but underpositioned markets have room to expand. And when they expand, they don't move slowly. They accelerate. Now stop, because this is where most people get it wrong. They assume if a move has already started, they're late. But in reality, the first move is often just the signal. The second move is where momentum builds. And the third move is where volatility spikes. Right now, silver may still be in that early transition. Not confirmed, not guaranteed, but possible. And possibility is enough for markets to move. Now here's your second curiosity hook. Why are central banks and policymakers suddenly becoming more relevant to this move? Even though they haven't made any official changes yet, because markets don't wait for announcements. They front run them every time. And if expectations continue shifting, if rate cut probabilities increase, if the dollar continues to weaken, then this move in silver could extend further, not in a straight line, but in phases. Now let's bring this back to what's happening right now. The ceasefire is temporary. Even Reuters reports highlight that markets are still uncertain about how long it will last. And whether negotiations will actually lead to a long-term resolution. That uncertainty matters because uncertainty creates volatility. And volatility creates opportunity, but also risk. Because if the ceasefire breaks, oil could spike again. Inflation expectations could return. And central banks could shift back into tightening mode, which would change everything. So what you're watching right now is a market caught between two scenarios. Scenario one, stability, lower inflation, potential rate cuts. Scenario two, renewed conflict, higher inflation, tighter policy. And silver is sitting right in the middle of that tension, reacting, adjusting, positioning in real time. This is not a calm market. This is a market trying to decide what comes next. And that decision may not take weeks. It could happen within days or even sooner, which is why this moment matters. Because transitions like this don't last long. They either resolve or they accelerate. And right now, silver is leaning toward acceleration, but the story is not finished yet. Now, this is where everything starts to come together because what looked like a simple reaction is beginning to reveal a pattern. Right now, silver is not just rising, it is breaking structure. Just days ago, silver was struggling around $72 levels. It was under pressure. The dollar was strong, bond yields were rising, and expectations for Federal Reserve rate cuts were fading. That environment, historically, is negative for metals. And yet, within 48 hours, everything flipped. Silver didn't just recover. It surged past 76, 77, even touching $77.18 intraday. That kind of move, in that kind of time, is not random. It signals a shift in momentum, but more importantly, it signals a shift in behavior because markets don't just move based on price, they move based on positioning. And positioning is changing right now. Look at what's happening globally. After the ceasefire announcement, markets entered what analysts call a risk-on phase. Stocks surged across continents. U.S. futures jumped more than 2-3% in a single session. Oil collapsed sharply. The dollar weakened, and capital began rotating. This is not noise. This is flow, and flow is what drives trends. Now think about this carefully. When oil dropped nearly 15% in one move, that didn't just affect energy markets, it affected inflation expectations. Because energy prices feed into everything: transportation, manufacturing, food. So when oil drops, markets begin to anticipate that inflation pressure may ease. And that matters. Because central banks, including the Federal Reserve, the European Central Bank, and others, have spent the last cycle fighting inflation aggressively. Now suddenly, there is a possibility, not certainty, but a possibility that pressure may start to ease. And when that happens, markets begin to reprice. Interest rates, currencies, commodities, everything. This is called a repricing event. And silver is reacting early. Now pay attention, because this is the moment where things become very real. Silver has now entered a critical technical zone, around 76 to 77. This level is not just a number, it is a threshold. Historically, when silver approaches this range, one of two things happens. It either rejects sharply, or it breaks and accelerates. There is rarely a middle ground, and right now, it is not rejecting, it is holding. That matters, because when an asset holds at resistance, it often means demand is absorbing supply. And when that happens, breakouts become more likely. Not guaranteed, but more likely. Now here's where things start to escalate. Because if this level breaks cleanly and holds above it, the next phase is not slow. It becomes momentum driven. Algorithmic trading systems begin to activate. Trend following funds start entering. Volatility increases and moves become faster. Now stop, because this is where most people underestimate what's happening. They see a move to 77 and think it's already extended. But in many cases, breakouts don't end at resistance. They begin there. Now let's connect this to something bigger. The global financial system right now is under pressure, not collapsing, not breaking, but stressed. Inflation has remained elevated across major economies, even after aggressive rate hikes. Bond markets are still adjusting. Even after the ceasefire, analysts say yields are unlikely to return to pre-conflict levels. Because inflation remains structurally persistent. That creates tension. Because central banks are caught between two forces. On one side, slowing growth. On the other, sticky inflation. And that combination creates uncertainty. And uncertainty creates volatility. Now think about where silver sits in this environment. It is not just a hedge. It is also tied to industrial demand, solar energy, electronics, infrastructure, and global demand for these sectors is not slowing dramatically. So silver is exposed to monetary shifts and real-world demand. At the same time, that dual exposure is what makes moves like this more powerful. Because when both forces align, the move is not linear, it expands. Now here's something you need to really pay attention to. This entire move is happening before key data releases. Markets are waiting for inflation reports, central bank commentary, policy signals, and yet silver is already moving. That tells you something. It tells you that markets may already be positioning ahead of those events, not reacting, positioning, and that distinction matters because positioning happens early, reactions happen late. Now bring this back to right now. The ceasefire is temporary. Negotiations are still ongoing. Shipping routes are reopening, but not fully normalized. Insurance risks remain. Transit costs remain elevated, and uncertainty still exists, which means volatility is not gone. It's just paused, and when volatility pauses, markets often reposition before the next move. Now ask yourself this. If volatility returns, if inflation surprises again, if central banks shift expectations, what happens next? Because silver is already moving, and when an asset starts moving before confirmation, it usually means one thing. Something is building, not visible yet, not confirmed yet, but building. And right now, that buildup is happening in real time. This week, before the next data release, before the next policy signal, before the next headline, which is why this moment matters. Because markets don't wait, they anticipate. And silver may be anticipating something. The only question is, what? Now this is where the story shifts. And so the counsen that gersen står na storken. From what you can see to what you're not supposed to notice. Because up until now, everything still looks explainable. Ceasefire, oil collapse, dollar weakness, silver rally. But what if I told you that's only the surface? Because underneath that surface, there's another layer. A layer driven by institutions, not headlines, not retail traders, not short-term reactions, but capital flows that move quietly before the market catches up. Right now, large institutions are watching something very specific, not just the ceasefire, but what comes after it. Because according to recent macro analysis, this ceasefire has already started to reset expectations around central bank policy. Think about that. Just days ago, markets were convinced that interest rates would stay higher for longer because inflation was being pushed up by energy prices. Oil was rising, supply was constrained, and the Strait of Hormuz was a major risk. That scenario supported a strong dollar, high yields, and pressure on metals. But now, that entire narrative has been disrupted. Oil drops sharply, markets reprice inflation expectations, and suddenly the possibility of rate cuts re-enters the conversation. Not confirmed, not guaranteed, but visible, and that changes everything. Because when central bank expectations shift, capital moves fast. Right now, bond markets are already adjusting. Yields have dropped to multi-week lows as investors move back into fixed income. And when yields drop, the opportunity cost of holding metals decreases. That's basic financial logic. But what most people don't realize is this. The biggest moves in markets don't happen when news is confirmed. They happen when expectations begin to change. And that's exactly what's happening right now. Now pay attention, because this is where things become even more serious. The Federal Reserve has not changed its policy yet, but the environment around it has, according to recent Fed discussions, policymakers are still concerned about inflation risks, especially those tied to energy shocks. And that creates a contradiction, because on one side, oil just collapsed, and on the other side, the risk of supply disruption still exists, which means inflation could ease or spike again, and central banks are stuck in the middle. That's not stability. That's uncertainty. And uncertainty is where volatility is born. Now bring this back to silver, because silver thrives in environments where the future is unclear, not always instantly, not always predictably, but historically, periods of policy uncertainty have supported metals. And right now, policy uncertainty is increasing, not decreasing. Now here's the part that most people are missing. Even though the ceasefire has been announced, markets are still calling it a fragile truce. Shipping routes are reopening, but not fully normalized. Insurance risks remain, transit flows are still limited, and full recovery could take weeks. Which means the system is not stable, it's transitioning. And transitions are where the biggest moves happen. Now think about what we've seen so far. Silver was weak during peak conflict, but now, as the system shifts, it explodes higher. That tells you something. This move is not about fear. It's about positioning, and positioning is forward-looking. Now let's go deeper, because institutions don't just look at price. They look at scenarios. Scenario 1. Ceasefire holds. Oil stabilizes. Inflation eases. Rate cuts become possible. Scenario 2, ceasefire fails, oil spikes again, inflation returns, central banks tighten further. Now here's the key. Silver benefits in both scenarios. In scenario 1, lower rates support metals. In scenario 2, uncertainty and inflation support metals. That's rare, very rare, because most assets depend on one outcome. But silver right now sits in the middle of both. And that's why this move feels different. Now stop, because this is where the tension builds. If an asset benefits from multiple scenarios, what happens when markets can't decide which scenario will play out? It becomes volatile. And volatility creates expansion, not always upward, not always smooth, but significant. Now bring this back to right now. Markets are entering a critical window. Between today and the next few days, key data is coming. Inflation numbers, central bank commentary, policy signals, and yet silver has already moved. That tells you something. It tells you that positioning is happening before confirmation. Now think about that. If markets were confident, they would wait, but they're not waiting. They're moving. And when markets move early, it usually means one thing: something is building. Now here's the real question. Is this move just a temporary reaction or the beginning of a larger repricing? Because if it's a repricing, then this is not the move. This is the start of the move. And that's where things become dangerous, because most people only notice trends after they're obvious. But by then, the majority of the move has already happened. Right now, silver is not obvious. It's confusing. It's unexpected. It's uncomfortable. And that's exactly how early moves look. Before they become clear, before they become crowded, before they become mainstream. So the only question left is this: what happens next? Because if this level holds and momentum continues, the next phase will not move slowly. It will accelerate. And when it does, most people won't be prepared. Now, this is the moment where everything you've seen so far starts to matter, because what you're watching right now is not just a move. It's a setup that is forming in real time. While most people are still trying to understand what just happened, silver has already surged above 76.6, $77 levels, driven by a combination of a weaker dollar, falling oil prices, and shifting expectations around interest rates. But here's the part you cannot ignore. This move is happening before confirmation, before the Federal Reserve makes any policy changes, before inflation data is fully released, before markets have clarity. And that's what makes this dangerous, because when markets move ahead of certainty, they tend to move faster than expected. Now step back, look at the full picture. Oil just collapsed nearly 15% in a single session. The dollar weakened below key levels. Global equities surged, and silver did something it doesn't usually do. It ignored the normal script, because historically, when geopolitical risk drops, metals cool off. But this time, silver surged anyway. That tells you something. It tells you that the driver is not just geopolitics. It's something deeper. Liquidity, because liquidity is the one force that overrides everything else. And right now, liquidity expectations are changing. Markets are starting to believe that central banks may not need to stay as aggressive. Not confirmed, not guaranteed, but possible, and possibility is enough. Now here's where things get even more serious. Global institutions are already reacting. Leaders from the International Monetary Fund, the World Bank, and the International Energy Agency are preparing to meet to address the economic fallout from this crisis. Think about that. This is not just a market event. This is a global system response. Energy disruption, inflation risk, policy uncertainty, all converging at the same time, and silver is sitting right in the middle of it. Now ask yourself this: if the system is stabilizing, why are institutions still preparing for crisis management? Because stability is not guaranteed, and markets know it. That's why volatility is still elevated. That's why positioning is shifting. That's why silver's moving early. Now here's the final layer. There are only two paths from here. Path one, the ceasefire holds. Oil stabilizes, inflation cools, central banks begin easing. In that scenario, silver benefits from lower real interest rates. Path two, the ceasefire breaks. Oil spikes again. Inflation returns. Central banks stay restrictive. In that scenario, silver benefits from uncertainty and inflation hedging. Do you see it? Silver is positioned for both outcomes. That's rare, very rare, because most assets depend on one direction. But this is a convergence. And when convergence happens, markets don't move slowly. They expand. Now stop, because this is the moment most people miss. They wait for confirmation, they wait for headlines, they wait for certainty, but by the time certainty arrives, the move is already gone. Right now, there is no certainty, only signals. Silver breaking resistance, dollar weakening, oil collapsing, liquidity shifting. Signals. And signals are where trends begin. Now pay attention, Because this is happening right now. Not next month, not next quarter, this week, before the next inflation data, before the next central bank signal, before the next headline hits. And markets are already moving. So the real question is not, why did silver move? The real question is, what is silver anticipating that the rest of the market hasn't fully priced in yet? Because if this move continues, if $77 turns into support, if momentum builds, then the next phase will not be gradual. It will be fast, and when it happens, most people will call it unexpected. But it won't be unexpected. It will have already started right now. So don't ignore this. Pay attention, because something is building in the silver market, and this may be the early signal before the real move begins, and the next few days could decide everything.